Thanks for joining me today for another stock analysis. In this video, I will explain why Procter & Gamble is likely to continue consolidating around $168 per share based the updates provided in its fiscal third quarter of 2025. The key takeaways are: P&G's FQ3 2025 earnings report shows declines in key segments. I believe such earning pressure largely came from headwinds from trade disputes and persisting inflation. I further expect these headwinds to continue and confine P&G stocks to be range-bound. Recent trading patterns provide further indicators for continued consolidation. I last analyzed Procter & Gamble stock, NYSE, P&G, back in Dec 2024. As you can see from the following screenshot, that article was titled Procter & Gamble, Inventory Does Not Lie and Points to Hold. A key reason for my hold rating was my following concern over its elevated inventory. This article downgrades my rating on P&G stock to hold from my previous buy rating. A mix of new catalysts have developed since my last rating, and I do not see a clear bias in P&G's return/risk curve anymore. My top concern is the mixed results reported in its FY 2025 Q1 earnings, especially the inventory data reported. I am also seeing heightened valuation risks, judging by its current PE ratio and/or dividend yield. Since then, there have been a few new catalysts evolving around P&G stock. In this video, I will concentrate on the top two on my mind, its FQ3 earnings report, ER, and also the latest technical trading patterns. P&G's stock prices have been indeed moving sideways since my last writing. As seen in the chart above, the stock price was $169 at time and has been range-bound between $160 to $180 most of the time. Based on the fundamentals updated in its FQ3 ER and also the technical trading signs, my verdict is that the stock prices will continue consolidating in the near future, leading to an iteration of my hold rating. Let me start with the fundamentals the company just updated in its third fiscal quarter ER, released on April 24 before the market opened. Overall, the results reflected ongoing headwinds in my view, largely due to softening consumer demand amid uncertainties caused by the trade and tariff disputes. The company suffered QQ declines in all its key segments, as you can see from the following table. To wit, for the third fiscal quarter of 2025, its beauty segment recorded net sales of $3,490 million, translating into a quarterly decrease of -9.3% and a YY decrease of -1.7%. The grooming segment's net sales experienced an even large quarterly decline of -14.1% and a YY decrease of -2.2%. Finally, the healthcare segment reported net sales of $2,880 million, with a quarterly decrease of -11.4% and a slight YY increase of 0.2%. Ahead, I don't expect profit growth to resume in the near future, as detailed next. Looking ahead, I see several headwinds that could keep its profit growth at tempered rates. To start, the company has been trying to counter operating and transportation/distribution costs lately, and I see these cost pressure to persist given the trade disruptions and stubborn inflation. Additionally, foreign exchange rates and also its ongoing divestiture/restructure efforts can also be limited near-term growth potential. Finally, and more fundamentally, I think more aggressive capital investments are needed in order to accelerate its growth curve. To better contextualize this discussion, the next chart displays its annual capex to revenue ratio in the past decade from 2015. As seen, the current ratio stands at 0.04 only, which is not only below the long-term average of 4.6% but also towards the low end of the historical spectrum. The ratio has fluctuated over the years but has been in an overall declining trend since 2018 from a peak level of 5.6%. The good news is that management's current capex budgeting points to an allocation of 4% to 5% sales toward FY 2025 capital expenditures. If the allocation materializes around the upper end of this guidance, i.e., 5%, it could bring its capex investor to be above history average and better support its future growth. Turning to technical trading signs, I am also seeing multiple indicators for continued consolidation. As aforementioned, P&G stocks prices have been snared within a consolidation range between $160 to $180 most of the time since my last writing. This is also reflected in the 20-day moving average in the next chart below, which has been oscillating lately with no clear direction. The current price is towards the lower end of this range and noticeably below the 20-day moving average, making it more difficult for the stock to break out in the near future. Before moving on, I want to draw your attention to the price volume bar highlighted by the blue rectangle boxes in this chart. This price range has been the trading range that has accumulated the heaviest volumes in the past 6 months. Due to large volume, I consider this price range, between $167 and $169, a critical resistance level. PG's current stock price is also well below this resistance level. As such, I don't expect the stock price to find a definite upward direction until the large number of investors participated in this price range to be replaced by more bullish investors. What are the positives? Of course, there are plenty of positives here too, hence my hold, rather than sell, rating. The company is working on a range of productivity improvements. These efforts ought to partially offset the cost pressure I mentioned above. As a reflection of the effectiveness of these efforts, the chart below presents its quarterly fixed asset turnover in the past 10 years since 2015. As seen, the turnover rate has dropped to a low point of around 0.8 only during 2019-2020. The company has been gradually improving its efficiency in utilizing fixed assets to generate revenue since then, and the ratio has steadily climbed in recent years. The current value hovers around 0.982, near the peak level over the decade. I don't feel an article on PG, a quintessential dividend growth stock, would be complete without a look at its dividend yield. To wit, the next chart illustrates its dividend yield from in the past 5 years since 2021. As seen, the current dividend yield stands at 2.57%, which is noticeably above the average yield of 2.39% over this period, serving both as an indicator of its attractive valuation under current prices and also a downside protection in case of a market downturn. Let me close with a macroscopic view to reinforce my hold rating. As a reflection of our top-down investing approach, our investing group service, Envision Early Retirement, developed the following market dashboard. It helps us to get an overview of various sectors before we zoom in on particular stocks. BTW, feel free to download the dashboard. It is coded as a Google Sheet. The broader staple sector as approximated by XLP is largely ranked neutral too in terms of its dividend yield Z-score. I believe this neutral ranking for the broader sector is perfectly applicable to PG2, which is a leading component stock for the staple sector and also the XLP fund, given the positives and negatives analyzed above. Thanks for watching and see you next time.